Well, good afternoon and welcome to what I believe is the MGA's 24th webinar this season. And we're delighted to introduce one of our valued supplier members today, Premium Credit, who will present on premium finance, an opportunity for MGAs in a hardening market. But just before we start proceedings, I'd just like to go over a few housekeeping. As you will see, you're all turned off and muted. The session is being recorded. And if you do have any questions, please click on the chat button at the end. You'll see it there on your screen. And we'll answer the questions at the end of the Q&A. The session is also CII CPD accredited, and we'll be circulating feedback forms following the event, and we really would like you to complete those. We cherish the feedback from you. The slides and podcasts will also be available on the MGA website following the event. And we're holding a couple of polls during the presentation. So if you are on Zoom app, I believe you will be able to participate. So without further ado, I'd like to welcome your speakers for today. Dave Sheath, who is Strategic Development Manager at Premium Credit, and Shane Dixon, who is Learning and Development Consultant at Premium Credit. So over to you guys. Thank you.
Excellent. Thank you very much for the lovely introduction. And as you said, my name's Shane. I'm one of the trainers at Premium Credit. We've been very busy over this lockdown period, training up to sort of 5,000 of our colleagues since the whole country was locked down by this remote method of webinar. And we're looking forward to taking you through today's course on what the opportunity is for you guys in the marketplace today. So that's me. I'm going to hand over to my colleague Dave for his quick introduction before we get stuck into the real meat of today's course.
Thanks, Shane. Yeah, good afternoon, everybody. As you can see on the screen, I'm known as Dave Sheath. I've been with Premium Credit for a couple of years now. I think Premium Credit are probably best known for their presence in the broker market. But my role specifically is to work with and manage our existing relationships with insurers and look to develop that, and also looking to develop our proposition with insurers and MGAs. So I'm here on hand to help and assist you guys with any questions and help you may need sort of after this session. So thanks very much. That's me.
Excellent. Thank you, Dave. And let's have a look at what we're going to cover during today's session. So clearly, if we took you guys on an hour journey of the whole world of premium finance, I imagine some of you would leave after a bit. So we've actually broken the course up into a few different sections for you today. The first part that we're actually going to cover is a little bit about market insights, which Dave will take you through. I'm then going to take you on a bit of a journey about how brokers are changing what they do, both by engaging with you and how they're engaging with their clients due to a hardening market, and especially with the changing market due to COVID. But as you can see from the agenda in front of you today, what we're going to cover from an objectives point of view, so we're going to look at list a minimum of 3 characteristics that do constitute to the hardening market. I'm pretty sure you could all reel 3 of them off for me now, but we'll look into a little bit more detail about what those characteristics are. What your broker community generally say around that is prices are going up, capacity's gone down. But clearly, you do as well as I know on this call that there are much more different facets as to why that market's hardening. And that's before we've even taken COVID into consideration. What we're also going to look at is 6 different stages of the market cycle. So highlighting where we're currently situated in that cycle. And clearly that will differentiate depending what risks you underwrite. We'll also look at how do we present a finance package to the brokers, which highlight the benefits that finance can have on them, because there's a great opportunity for MGAs like yourself to put a clear and consistent offer of finance. But again, I'll reiterate, this certainly isn't a sales pitch. There's some real key insights about how the market is performing, what people are doing differently, and of course, we will get your opinions and use your expertise throughout today's course. So hopefully that sounds good. I'm going to go into a little bit more detail about that roadmap really briefly. So the first part we're going to look at is those industry, market and economic insights. So what is the state of play at the moment and how does it impact both us, your brokers, as well as end clients as well? We're also going to look about what brokers are saying about that hardening market. We're then going to look at the 6 stages of the market cycle and where we're at. And then we're going to look at how brokers are communicating with you and what are they doing differently because the market has hardened, or are they even doing anything differently, and should they be doing anything differently? And then we're going to look at how that offer of finance can help you guys, also help your clients, and be a win-win situation for all. So hopefully that sounds good, and Dave is going to take you through the first few bits, which is really about that insight. So we're going to look at this in 3 different stages, one being as a macro economy, one into the insurance market, and then one about premium credit itself as a business. So Dave, over to you.
Thanks, Shane. Yes, so the first thing I want to look at really is obviously it's been a very unusual few months for everybody, and we really wanted to just share a few of the economy insights that we use and we look at sort of as part of the business. The first one will really be interesting around gross written premiums, where, as you can see, they are expected to be 1.7 down for 2020, and recovery time is a couple of years until 2023. Now, clearly, we're in an economic slump, and in fact, the worst economic slump in history, with a 20% downturn in GWP in Q2. I think one of the things that's really, we're really seeing a lot in the press and really aware of is that, 80% of the UK economy is a service-based industry, so it's particularly impacted some of our sort of travel and leisure type businesses. And whilst there are signs of recovery, that we are still looking, considerably down in terms of forecasting, looking forward. Unemployment is clearly up, and I think as a business, premium credit certainly have an eye on when we share some of the, insights that we've seen over the last few months. Certainly we have an eye on, the future employment market, what might happen when the furlough schemes come to an end. But clearly there's an increased number of redundancies, and that may well change future, as we look forward in the future. In terms of the market, really looking particularly, I guess, from our perspective in the lending market, a couple of these stats might surprise you slightly. So, the consumers, the end consumers, individual customers have actually repaid more debt than the value of new loans they've taken out during the lockdown period. Really, that's probably as a result of them having a sort of more disposable income. I think the trend is starting to change. Mortgage lending is increasing slightly, so that sort of is changing slightly. Clearly, corporate businesses have borrowed more throughout the period and raised more from financial markets, and particularly in the SME sector, there has been an increase in borrowing, really likely to reflect, the additional drawing down of loans through the government, the government schemes that have been in place. So, premium credit. What have we seen throughout this period? I suppose the first thing to say is that premium credit have, it's on their 2.1 million clients. The vast majority of those clients are insurance buying clients with relationships via insurers and brokers and MGAs like yourselves. But we also have another sector of the business where we lend specifically for season tickets, for tax or for FCA fee payments, etc. But the vast majority of our business is in the insurance sector. And in that insurance sector, we've helped over 16,000 clients across our personal lines, SME and corporate lines with forbearance. Forbearance is one of those words, excuse me, that probably not many people heard before this period. With some kind of sort of payment holiday or payment deferrals. So, allowing customers to delay, their payments by a month or by 2 months if required, really to help them through a difficult period. And the pleasing thing is, whilst that's been been a very busy time for the period for the business with lots of calls, etc., we've been able to support 99.6% of requests from customers, which is really pleasing. One of the things we have had to have an eye on is, from an underwriting perspective, particularly in some of the larger sort of corporate loans, we have had to take a slightly different approach in terms of our underwriting, finding out more information about those businesses and how they're impacted by the pandemic. A couple of areas we're really focused on are on what's happened in terms of customers missing their payments. In the consumer world, I suppose probably quite surprisingly, our missed payments, have actually remained within our normal range. We haven't really seen any real spikes. In the SME and corporate world, we did see a spike for a short period, but business, those levels have been returned to normal in the last couple of months. And clearly, from our perspective, and I'm sure this will resonate with yourselves, there are certain sectors that have been severely impacted. So a couple of examples are sort of the taxi and the travel insurance sector. I suppose where premium credit is slightly unusual is that whilst we've been very busy at one end of the business helping customers who need our support because they've been struggling, we've also seen an increase in demand for our product, really as a result of customers wanting to, and customers and clients and businesses wanting to spread the cost of their insurance. And we see this at times of recession and a hardening market, where there is that increased demand for the products we have. And really that's the opportunity that we want to explore with you a bit further, specifically for MGAs, a bit later in the presentation. Thank you, and I'll hand back to Shane.
Excellent, thanks Dave. So hopefully some of those market insights were useful. I'm sure you're aware of some of them, but certainly from a premium credit perspective, actually how it's impacted customers, which is clearly quieting off a little bit now, as Dave said, but also we've definitely got an eye on what's going to happen over the next few months, the potential second wave, as well as the potential redundancies that we've already seen started to come through. So that might impact us further. So like I said, we're going to go through a course today regarding the hardening market. Now, clearly you guys are very, very aware of what's been happening in the marketplace, but we're going to dig down into a little bit more granular detail. What I'm also going to do is run a couple of polls, so get your thoughts and your opinions on what's happening in that hardening market. So I'm going to do that first, and you have to bear with me. I've only practiced this on this system once. So what I'm going to do is launch a quick poll. Hopefully you should see that on your screen, and the question on that will be what are your thoughts on the continually hardening market? And there should be some multiple choice answers, and hopefully they'll pop up on your screen now. And then if you could just click the answer that you see relevant, hopefully I should see some percentages come up on my screen in front of me once you've all voted. Whether you think that's a real struggle, is you're not sure what it is it really challenging, is it an opportunity, has not much really changed? So really I'm just doing this to try and gauge the thoughts of what you think of the community in here about that hardening market. Excellent. I think we've got a couple more to vote if you still can. I'll leave that open for another 10 seconds or so. We've got some clear answers, which I will share with you in a second as well. So you'll get a feel for what people on this call actually think of the hardening market, because clearly we can all see these things in completely different lights. None of them are right or wrong, but actually, let's just get that gauge for what's going on here. So I'm going to close it now. We've got 19 votes in there, and I'm going to share those results with you. We have a clear winner. So we've got 16% of people think it's really challenging operating in a hardening market. Whilst I agree with you, yes, but actually is the market not hard for everybody? And we will delve into a little bit more detail around that shortly. We've got 68%. So the vast majority of people in the room today think it's a great opportunity. And I tend to agree with you. And then we've got 26%. So a quarter of us in here say, actually, nothing's really changed for me. It's BAU, and we just carry on. So really interesting to get those results. I'm going to close this one down, and I'm going to open another poll up. And what I want to get from you is a slightly different question for you, and I'll launch that one now. So this is, how has the hardening market impacted your approach with brokers? Have you changed anything? Has your full process changed and you're embracing it? Is it now taking you longer to provide rates for your brokers, or you're struggling to meet brokers' requirements more frequently? So there should be another poll in front of you. Once you've closed down the original poll, we get some of your thoughts on this one as well. So them results are coming in thick and fast. I'll just leave them up for another 15, 20 seconds to make sure everyone can read through the full spectrum of choices on there. Excellent. So a few more seconds. I think we've got at least half people have responded in that, which is good. Much more even split that we've got in results this time, I think. Excellent. So I'm going to close that down now. Thanks for everyone that's responded to that, and I will share those results as well. We've got a clear winner again on this one. So the top answer of that one is actually it hasn't changed our approach at all. That's 56%. A quarter of you have actually changed your approach, possibly even fully, but you're also embracing that change, which is great. It's that forward-thinking mindset. We've got 19% of people saying it's now taking us longer to provide rates for our brokers, which is quite interesting. So bearing in mind, my role normally entails here at Premium Credit is engaging much more with the broker community than it does in that insurer and MGA space. So what I find quite interesting, and I'll share some of these observations with you shortly, is actually how we see things differently. And clearly brokers might have a different mindset and an opinion on what they believe in the hardening market, because I guess from a majority they're dealing with that end user, whereas in the majority you're mainly dealing with those brokers, so maybe there's a little bit of protection there. So really interesting to see your results there. I'm going to close my window down here for the poll. I do believe for you guys there, you have to manually close the poll for yourself in order to move it from screen, but it's good to get your impact. Now, I've been running a session with our broker community now for the past 5 to 6 months, and I asked them a very, very similar question to that I've asked you. Now, I'm just going to go through some of those results. So this is what brokers are saying about the hardening market. So they're saying that their clients can't afford the premium increases and they're being forced to reduce cover in places, which clearly is not what we want for anybody. From an insurer MGA point of view, there's definitely opportunity left on the table because clients are reducing that cover. And then from a broker community, they're reducing that. And then from a finance point of view, we're losing out as well. So everybody loses out in that top left-hand corner box, although the client was probably underinsured for what they need. On the right-hand side, we've got the insurers, MGAs are applying more limitations to that cover, which clearly what happens in a hardening market. So that's dead on correct. In the middle, we've got more opportunities are presented with the fact that clients are looking around for other options. And this broker in particular said that they're actually happy with that because they have such good relationships with insurers and MGAs. So they see it as a great opportunity. Moving down into the bottom right, we've got from a broker point of view, they're finding having those challenging conversations with their clients much more difficult as they're used to prices remaining steady. And we'll talk about that in a little bit more detail on the next slide. And it has been a buyer's market for the past 6 or 7 years. And, you know, consumers have had it pretty good, right? You know, price increases have been very, very minimal across the insurance spectrum until the last 18 months or so. But actually preparing those clients in the long run is certainly what that broking community should be doing. On the bottom left, the last one we've got here is we're at higher risk of losing our renewals now that clients are forced to shop around, which is quite an interesting point, isn't it? Whereas actually clients could always shop around. Is it that the premium increases are so much that they're being prompted to do that? And actually, would I say that that's due to the price increase or due to that broker engagement with their end client? That's a debatable point. So that's what brokers are saying about the hardening market. And when I generally question them as to what is a hardening market, and they say prices are going up, capacity's gone down, which is pretty universal across the board from our broking community of what I get. But I'm sure that you know much, much better than some of our broking community about what those real characteristics of a hardening market are. And we're going to dive into a little bit more detail around those as well. So the first point that I have here on my slide is the one that we've just talked about, which is general common knowledge, which is sustained and significant rate increases. So as we know, a hard market is characterized by sustained and significant increases. We wouldn't class a 1% year-on-year increase as a hard market. But clearly, you guys can't just raise rates off the hook. You have to do it in response to some certain challenges. And namely, they would be stuff like poorly performing combined ratios, as well as return on equity being down. So some key factors that have caused poor performance, stuff like the property and casualty lines around the world, which includes climate change, but also that increase in catastrophic weather events. You have stuff like social inflation and an increasingly challenging litigation environment, as well as those macroeconomic developments that Dave took you through on the insights part a little bit earlier on during today's session. And this is before we've even taken into consideration the impacts of COVID, which could completely change a hard market, both for the good, it could be worse, depending what happens with a few certain things in the industry. The next point we've got is reduced capacity. So you might find that capacity is reducing already as the market is shrinking. So when insurers, MJs, you are faced with hard market conditions, you generally find that your insurers will start restricting the amount of capacity they're willing to put up against those certain risks. So many will conduct what's known as portfolio remediation. That means they shore up their underwriting, as you know, and the risk selection guidelines and existing lines of business. And they also then completely get rid of those non-core or even those poorly performing risks as well. The other part I mentioned there was the fact that those combined ratios up and that return on equity is down. So clearly, as we lead up to that hard market, the insurance industry posts combined ratios way above 100%, which is normally around 105% or even above, and that will be for multiple years in a row. So that means in core terms that the industry pays out more in losses and expenses than it collects in premium, which is clearly not sustainable in the long run. Now, as you know, that doesn't mean that they're not making profit, because it doesn't include investment returns or anything like that. But actually, from a sustainable part of view, from losses to premium, if you're not making money there, then something's got to change. So at the same time as this happening, the average return on equity is dropping dramatically. So insurers, etc., you want to make a return on equity of about 10%, and that's to cover the cost of your capital, but also generate that return for shareholders. Whilst we head into the hard market, the return on equity comes down to probably about 1 to 4%. So we're not making enough. And because those combining ratios are eating into the returns, what do we need to do to offset those challenges? Well, we have to collect more in premium, right? So depending on the severity of the issues and the regulatory space that we're in, that correction has to take place. And that started about 18 months ago. Also leading up to that hard market, we've got those increased reinsurance costs as well. And that's rapid increase in reinsurance costs. So as we know, the reinsurance market drives insurance pricing. So if the reinsurers are increasing their costs, what do? We have to increase our costs as well. So as one rises, so does the other. And there's multiple different reasons why the reinsurance space goes up as well. Similar to before, as casualty, natural disasters, etc. I saw the Hurricane Lara last week. We're expecting payouts of between 4 and 12 billion, just like that, unexpected. What we've got as well is a reduction in the number of new market entrants into the field as well. Because profit margins are down in a hard market, it's no surprise that you're not going to get new players enter into the marketplace because the profitability isn't quite there. So what new players would generally do is time their entrance into a hard market or into the insurance marketplace right at the end of a hard market. They get to ride the waves as more players come in, prices getting driven down while profitability goes up. Then we've got lost portfolio transfers, also impacting what the characteristics of that hard market are. So as you know, you can use a certain type of risk financing called that lost portfolio transfer. That's a kind of treaty where an insurance carrier gets rid of a poorly performing book to a reinsurer. That reinsurer takes the insurer's open and future liability claims through the transfer of the insurer's loss reserves. So that helps us in a hard market by getting rid of those liabilities from the balance sheet. So rather than just those two things we spoke about a minute ago, that capacity's gone down and prices have gone up, there's some of the reasons behind that. And we're happy to discuss any Q&As on those a little bit later on. So we've got much more insight. So where are we on this hard market space? Well, here's a lovely little chart that I've seen knocking around over the past few months as well. And generally we find, and depending on how long you've been in the industry, whether you've experienced this curve before. Definitely there's some of us on the call today that have probably experienced the curve 2 or 3 times, and others we haven't experienced the whole curve. So from my point of view, when I'm out training brokers, some of them will be youngsters, 20, 22 years old, and all they've ever dealt with is prices going down or remaining pretty flat. Then when it comes to a period in time where prices are going up 10, 15, 20%, it's a completely new space to be in, and they have literally no idea what to do. But if we've been in this cycle before, actually, we know that this is how the cycle goes, and it just is, right? There's not really much we can do about it, apart from doing the things we already do, but just a little bit better is kind of the message we get across. But I'll save that one for another day. But I did promise to discuss the 6 stages of the market cycle and roughly where we are now. And again, that does depend on the type of risk you're underwriting. So we've got right at the bottom of that curve there, where that gold star is, that key turnaround point, that was probably about 10 to 12 months ago across the industry as a whole, where it kind of moved from that softer market into a much, turning that curve into a harder market space. We then move into phase one, shall we call it, which is that initiating hard market, where you see that some insurers were pulling back out of the marketplace and they weren't really being replaced by anybody. That then drives that capacity down, so prices start increasing, as well as that return on equity where prices had to get pushed up. So you're combining both of those, of that lack of capacity plus having to push prices up. We then move into this accelerating hard marketplace, which is pretty much where we are now, where we can see generally across the board, prices are getting pushed up, but not by 1 or 2 digit figures. We're looking at, 10, 15, 20%, depending on what kind of risk you're underwriting, but certainly along D&O, they're going up 20, 25, for instance, in some instances. So we believe we're around that big white star there between 1 and 2 at the moment, which means that it's probably going to get harder. And this doesn't even take into consideration the state of the economy after COVID. So we might see, depending on what happens with the BI cases, for instance, where you might have absolute huge payouts across the board, that curve could potentially double the curve rate and go up much, much higher and much more rapidly. But alternatively, if that doesn't happen and there's not those dramatic payouts, that might then soften the market a little bit. The reality with this thing is we're trying to guess what's going to happen based on foresight and analytics, but the reality is we're not that good and we don't really have crystal balls. But this is a general curve which we've seen rolling over the past 20, 30 years, for instance. Then we move into that stabilizing hard market. We're potentially looking at, it could be a year, 2, 3 years. We're expected to be in recession now for a little while as well. So that might have some impacts as well. And then we've got that magic gold star, which is actually when you start getting some leveling off in the marketplace as well, where consumers get that relief and hopefully brokers do as well. And then we move more into that initiating soft market. So, a minute ago I said, actually, at what point do those new players enter into the insurance market? It's generally around that stage 4. And then they think, actually, there's a lot more profitability, prices here. That then causes a huge flood of new players into the marketplace. That's ultimately then going to drive those prices down, drive that profitability down as well. And that accelerates into that soft marketplace. And then guess what happens? Traditionally boom and bust, which we've run as a country for the past 40 years, I believe it is. We get into number 6 and that cycle all starts again. So there was a little bit about our 6 stages of the market cycle and where we believe we are. You might have different thoughts about where we are, and even depending on the risk you're underwriting might depend on where you sit on this and actually what the potential increase is and when that might flatten off. If you've been in a marketplace which has already been hardening for 2 years, you might find that flattens off a little bit sooner than others. So I hope that little section was useful there. What I'm going to do now is take you into a little bit about how brokers are changing the way they engage with you. So some of you said that you're not doing anything different, and clearly some of our broking partners aren't as well. But a lot of them are. In fact, I've even attended training courses with some real big players in the country about what they're asking their staff to do in order to engage with you differently or better, however they want to see it. So here's a few points that I've got here. So what they're saying is, you should expect to receive better presentations from your brokers. So the broking community are challenging their teams, their account execs, directors, handlers, etc., to do more know your customer checks and present you more background information. Also to show you much more risk appreciation, but also for them to engage with their clients to show you the improvements to previous risks, to hopefully mitigate any of those increases. So I'm not sure you have. We can certainly put some notes in the message box if you have got better presentations from your brokers, but this is what they're asking their brokers to do when they engage with you in a hard market. What they're also saying is, don't just send those presentations over with a quick email going, what can you do with this? They're asking them to reach out, discuss it with you, talk about those risk improvements and that risk appreciation. How have things changed for that customers? What else might be available? Having that personal contact. That's a real key thing that brokers are saying for people to engage with you, is make sure you keep those relationships in play. They're also saying, why not ask the question about long-term agreements? Now, I know that these are rare. In fact, I haven't seen one for a little while now. But they're saying, actually, why not ask you that question? Is there some long-term agreements that we might be able to do, which works for everyone? You know, we can have that client for 3 years, potentially, if they're available in the risk that you're underwriting. But their brokers are asking their teams to ask you those questions. Now, what they do very much understand, and I couldn't tell you how many hard market training sessions I've attended, both with brokers, but also engage in conversations with them as well about how the market is changing. So they're aware price is going up, as I showed you from one of those slides earlier. They're aware pricing is going up quite substantially in certain industries. It's about what are they doing differently to manage their clients' expectations. Now, I noticed on one of the polls that we done a minute ago that we're saying that it's taken longer to underwrite in some instances. Well, actually, what we've been telling brokers and what they're doing amongst their team is saying, look, let's start this journey much earlier. How much better does it sound that your trusted consultant who deals with your insurance reached out to you 4 months in advance of your renewal, told you what was happening in the marketplace about those potential price increases, and managed that journey through with you? Isn't that a much better experience than landing a renewal letter with a 30% price increase? So brokers are expected to do that, and they are changing completely the way that they're engaging with their clients. They're preparing them a lot earlier. They're trying to know them a lot better and really understand their business, maybe in a little bit more detail than they were previously, because they knew that they could keep such a high percentage of their clients. So what you're finding at the moment is that renewal rate's probably dropping down slightly because people get scared by the increases at renewal. Then what we've got here is brokers will be clearer what they want from you and will be better prepared to negotiate and challenge. Now, I can hear some virtual laugh here about some of you clearly haven't had that experience from the broker community, but this is what they should be doing, and hopefully this is what you expect people to do is, you know, be clear, be concise, show that they understand the customer and they've appreciated what risks are there and how they could mitigate them. But from a broking point of view, they're also going to negotiate and challenge with you, and challenge hard because they're looking out for their client's interest also. And the last few things that I've got here about how they're actually preparing is they're telling their clients in advance. So for instance, we dealt with a very large national broker recently. Now, they are telling their PI clients to expect a minimum of a 30% rate increase. And that's across PI, D&O, E&O as well, and they're all hardening very rapidly. So at least the brokers are telling their clients this way in advance to hopefully soften that ground for when ultimately that final price does drop. Also, they're saying watch out in the marine and construction space, and it's also likely that property rates will harden after those large losses last year, and also if there are any settlements for BI through COVID. Now, again, we're in a bit of an unknown territory there. We know that court case is going through at the moment. If that comes through and there's big payouts, then we potentially see that market harden even further and faster, with much more dramatic price increases could be there as well. And then we've obviously got probably one of the most effective areas is cancellation and curtailment, certainly in events, and also aviation would be massively impacted by claims. So we're going to see, and you might have already seen them, those rates rise significantly. In fact, I've been dealing recently with a few aerospace teams who are now looking into this finance space, which traditionally they wouldn't have even touched before because their clients were just paying full. Now, looking at those price increases being so dramatic, actually thinking of, is finance a way to kind of soften the blow of those dramatic price increases? So hopefully that was quite useful in how your brokers and what they are doing differently, as well as some characteristics in the hardening market. But what I want to do is talk to you about now is, what does this mean to you? So we've looked at lots of the insights to the economy. We've looked at the hardening market, what actually causes it. We've looked at what brokers are doing differently as well to engage with their clients. And we saw, I think about 26% of you said you're not really doing anything differently either. So actually, sorry, it was a lot higher than that, wasn't it? So we're not doing anything differently, but actually what my challenge would be is there anything that we could be doing differently? So I'm going to put up a lovely little table that we made earlier in true Blue Peter style. And I've got this lovely little chart here. Now, you guys sit at the top here as an MGA underwriter insurer, however you want to position it there from there, but effectively that MGA who's underwriting the policies for all of these different brokers. Now, you know, potentially there could be hundreds of these brokers, but I've only put a few here just to kind of give us a nice visual overview to actually what we mean here. Now, on the left-hand side is what we call penetration. So let's say, for instance, I'm a broker and I write 100 different policies for my clients, and 20 of those clients decide they want finance. Their finance penetration is 20%. And for these red clients here that you can see the red boxes, these are premium credit customers that would work with you as well, but we provide the end finance to those brokers there. To those ones in blue, there are competitors, and potentially even green, there are different competitors in the premium finance marketplace. You potentially work with brokers that use us, brokers that don't use us, and to the far right, you've got brokers that don't offer finance to their clients at all. And why would they? Some of them don't need it. If you can get the cash in there in one lump sum, then some brokers absolutely do that. But if you look at that red box in the bottom left-hand corner, it says, we tend to offer finance to most of our policies, but we know some clients are very well off and we don't think they need it, which is really interesting. And I promise you, I come across this so many times that, yes, brokers know their clients in detail, but sometimes they don't appreciate what might have changed in that client's business or life, for instance. So we presume that, yes, they're very cash rich, so of course they're only going to pay in full. I'm not going to offer them finance. Now, they would argue that we do offer them finance, but I would counter argue that with, there's a complete difference between having a discussion with your client about finance and putting a finance quote in front of them than including it on page 32 of a renewal pack with a slight bit of writing that there are finance options available for you. And that's across any premium finance supplier. I would also challenge you that actually, from Premium Credit's point of view, if I asked you on this call who our closest competitor is, you would probably say Close Premium Finance. Well, actually, the reality is it's those clients that pay in full. There's so much more opportunity for us there as a business for clients that pay in full, rather than doing a little tap dance with Close and they steal a customer of ours and we steal a customer of theirs. Actually, it's about getting a clear and compliant offer of finance in front of all clients. And that's really where you guys can come in, because you get to engage with all of those brokers, and there's generally finance commission available. So yes, we might work with half the brokers, our competitors might work with half of them also, but actually you have that luxury position of being able to offer any of those clients a clear and concise offer of finance and potentially make some more money out of it. If you could make an extra 1%, 2%, or 3% just by getting a client on finance, actually, wouldn't that be worth your while? So what I'm going to do is take you through actually how do we do that. Now, I worked a quick stat the other day that I believe there's around £6 billion of GWP written through the MGA community. Let's say 10% of those clients would take finance. And that's a very low penetration rate, for instance, and that still leaves some with the broking community as well. If you only earn 1% of that, there's potentially £6 million of commission payable per year to the MGA community, just by getting a clear and concise offer of finance. And like I say, we work with a few of the MGAs already anyway. We also work with the insurers. Predominantly, it's mainly in that broking space who might offer finance to their clients, but as we see from there, they don't offer it to all of their clients. And sometimes people only offer finance to their clients if they think they can't afford it, because they just presume that clients don't want to pay an interest rate. Now, my challenge to those people would be, generally what I find in the marketplace is there are two reasons that a client might take finance. One being, I don't have the money in the bank to pay for that premium in full. And the other being, what else could I do with that money? Now, I know at the moment, during these times, actually companies aren't really looking at those reinvestment opportunities. Effectively, it's let's keep the cash in the bank because cash is king. But outside of that, actually, what can companies do better with it? Can they make more money by spreading their costs and reinvesting their capital back into their business than they would by just paying for their insurance in full. So what I'm going to do now is just show you this part here, and this is some of the quote tools that we actually offer you guys. It's built into our core platforms. The first one here is our quote pack. So actually, if you're presenting an offer to a broker, you can include one of these quotes. It simply gives your clients different ways of paying. So you've got a 6-month installment option, a 10-month and a 12-month. What would the fee be for that? And that would be determined by you. And obviously you've got a potentially better economy to scale than some of the smaller brokers you work with. What the fees and charges are, what the monthly payments would be, and exactly how that would work out for your clients. So that's what we call our quote pack. You get multiple repayment options. It's very, very easy to set up, and it can support the current crisis by easing some of the burden. You might find a lot of clients will think that it's only pay over 12 months, for instance. Actually, there's multiple different options that you can take advantage of to offer to your clients, as well as earn a commission override from those as well. So there's a nice zoomed in version for you to have a look at, and that's certainly something you could include just in your presentations back, or your offers back to your broking community. And if it is a keener rate, then surely from your broker's point of view, it's the right thing to do and put on the table in front of your clients. And then the next one I've got for you is, a minute ago I talked about actually what's better for clients. Is it reinvesting their capital back into their business at their return on capital employed, or is it paying insurance premium for and having no interest rate? Well, actually, we do provide tools as well with our platforms that can present this back down to the client, or you can present to the broker to show that client. Some of this information you might not know, but there's also little kind of helpful bits on here, because we don't expect you to be finance experts. So everything financial on here is really easy for the end customer to understand, or the broker. For instance, did you know that there's corporation tax relief on the finance charge? So effectively reduces the end user's interest rate by 19% currently, with the potential to go up if we do get corporation tax increases over the next 12 to 24 months. On that as well is what we call the client return on capital employed. Now, you might not know this, but certainly Premium Credit can help and provide you this information to show your clients what would be more cost effective for them. Is it reinvesting the capital, or is it paying in full? And we're not one-sided on this. If it works out better for the client, that they're better off paying in full and it will be more cost effective for them, then this chart will show them that. And that's what the blue and red graph at the bottom is. On this example here, the red is what they pay on interest to Premium Credit over the lifetime of a credit agreement. The blue is what they make by reinvesting that capital into their business at their return on capital employed. So a really good way of doing it is presenting finance to every client. Utilize this tool if you need to, but what I would say as a minimum is get a quote pack out. Again, we've just worked out there's potentially £6 million in commission on the table. Wouldn't we want a part of that? And it certainly should be part of that primary offer due to those current market conditions as well. So there's my kind of bit around getting that clear, concise offer of finance on the table to all of your clients. And there is a lot to be left on that table as well. So I'm just going to summarize on what we've covered during today's session, and I will send out any supporting information also. So what we've covered during today's sessions were the characteristics of a hardening market, which we know were rate increases, that reduction in capacity, the increased loss ratios, those reinsurance costs increasing, that complete lack of new market entrants, as well as the lost portfolio transferring, all impact how hard that market becomes, and that doesn't even include COVID. We also looked at the 6 stages of the market cycle, identifying where we are of that stage 1. So in that initiating hard market phase that we're in currently, and who knows how high that and how sharp that curve is going to be. We'll definitely find out in the next 3 to 6 months. And then from what opportunity is there for you as MGAs to potentially increase your earnings during this time is offering finance to all of your brokers. Utilize the quote pack we give. It's a completely free tool that comes with our platform, and use the CBA tool to deliver to your brokers to get that message across to them as well. So really that wraps up all the bits from myself, Shane Dixon. I hope you found the session quite useful and interesting, and hope there were some bits for you in there. I could potentially hand over to Dave if there's anything you wanted to add.
No, I don't think there's anything to add, Shane. Just I think hopefully, Paula, there might be some questions coming in that we can look at, and really just to thank everybody for their time and attendance, and hope they found it useful.
Yes, gentlemen, we have a couple of questions here. One of them, how much of the transaction charge do premium credit retain, or is there an upfront cost?
Sorry, Paula, could you say that again? Sorry.
Sorry, how much of the transaction charge do premium credit retain, or is there an upfront cost?
Yeah, I'll answer that one if okay. So the percentage it does depend on, I think Shane mentioned during the presentation, on depending on the I guess the size and scale of the opportunity and what the total volume of the advances would be. So we would agree with respective MGA partner what our net rate cost would be, and they would then obviously agree what they would then charge that out to the customers, and the difference would be what they retain. So it's a variable amount, Paula, but it's generally pretty simple for us to work out what it would cost us based on the based on the volume of advances and over what period of time it's going to be, whether it's 6 months, 10 months or 12 months.
And another question, Dave, is it difficult to set up a finance agreement?
Another good question. There's a number of ways that it can be done, depending. I think Shane mentioned we have a couple of platforms we use. We use a personal lines platform, which is called Plasma, and a commercial lines platform, which is called Interactive. So to give you an example, on our Interactive platform, there's 4 screens that need to be completed to set up a credit agreement, and actually it's quite intuitive in terms of you populate a company name and it puts the rest of the details in. So actually it's far easier than, for instance, filling out a loan application for a bank. So pretty straightforward and easy.
And also for international business and for clients, and for those MGAs who are writing and dealing with international clients, does this only apply to UK domiciled companies?
No, the insurance can be conducted, the actual insurance itself can be conducted anywhere overseas, and it applies to UK and non-UK businesses, but there does have to be either a UK or Irish legal entity, or a subsidiary registered with the Companies House, which is actually trading. So there are some rules that govern that. So in simple answer is yes, but there are some qualification rules around that, Paula.
Great. Well, that's it. And thank you again. Thank you both, Dave and Shane, for a really good presentation. And thank you to all our delegates today for attending. And we do hope you enjoyed it. If you have any further questions, please get in touch, obviously, with Premium Credit or with ourselves, myself, Teresa, or Ben at the MGA. Thank you and goodbye.
Thanks very much.
Thank you.